Hello Maverick traders, this is Imri and welcome to today's class on the characteristics of corrective price action. Alright, so last week we went over the characteristics of impulsive price action. And just as a quick refresher, there are two categories of price action, which makes market analysis a lot easier once you can wrap your head around this concept. So we have got impulsive price action and corrective price action, and last week we went over impulsive price action. So impulsive price action is the kind of action that creates new higher highs or lower lows. So it's movement that is definitive of a trend. It's trend defining, and they're the kinds of price movements that all traders want to capture. We're talking about those big moves that take place over a relatively short period of time, and you're wondering why can't every single trade be just like that? So we're going to take a look at the other side of the fence today, which is corrective price action. Now, corrective price action is characterized by choppy, sideways, sloppy price action, which retraces a percentage of the prior impulsive wave. Too many traders attempt to trade corrective price action, and I have a theory as to why that is. So markets don't trend the majority of the time. Right, depending on the market, depending on seasonality and cycle, I'd venture a guess that markets are trending roughly 20 to 30% of the time at most. Okay, so the vast majority of the time, a market is actually consolidating or correcting, which means that odds are when you open up your trading platform and you're going through the different price charts of the different markets or currencies that you're looking at, odds are high that you're going to be witnessing a market in a corrective mode of behavior. So what happens then? Well, you say, I've got to play the hand that I'm dealt. Let me look for a suitable trade. And I see too many traders ending up forcing trades while the market is still within a corrective phase. And that's when you get chopped up. That's when you get whipsawed. No good. So we're going to hopefully rectify some of those mistakes or some of those traps that are so easy for all traders to fall into today. So moving on, let's take a look at some corrective price action right here. So corrective price action is counter trend. It retraces a percentage of the prior impulsive sequence, like I mentioned. It's typically quite slow moving. So it's choppy, sideways, and sloppy. And there are two subcategories of corrective price action. There are sharp corrections and sideways corrections, or another way to think of it is there are corrective sequences that correct through price, which would be your sharp kind of correction, and then there are corrective sequences which correct through time, which are your sideways corrections. So here we have corrective price action, right, which is correcting through time and it's moving sideways, and then we have the impulsive phase, which is taking off like a rocket. So corrective sequences are the worst sequences to trade. Like I said, they move slowly, they tend to whipsaw back and forth, and there really isn't a sustainable move that you can take advantage of. So here's a great example of that impulse correction sequence. This is in Euro Yen on a daily time frame chart. So you can see the blue arrows are the phases of the market where we're witnessing impulsive price action, and then the orange arrows show the corrective phase of the market. So you can see we have this lengthy corrective sequence here. Now, this is on a daily chart, so if you drop down to a 15-minute chart, sure, there might be reasonable opportunities, but again, this is just my personal opinion. I would just avoid this altogether. Move on to another currency pair that doesn't have this prolonged period of sideways consolidation on the daily time frame. Right? That's the advantage of looking at many currency pairs and having access to other currency markets like cryptocurrencies, that we can find something that's setting up impulsively. All right. So what we want to be doing as trend traders is not trading during an impulsive sequence. We already want to be in the market as the market is trending impulsively. We want to be looking for trades that time the end of corrective sequences. Right now, when I say time, I don't mean you have to be there the exact second, minute, hour, or even day, but you don't want to be trading somewhere in the middle of that corrective sequence, like right here. You probably want to be trading near the end of it, so near any of these lows here, right? Or on a breakout, if that's the kind of setup that you're looking for in your trading plan. Now let's add another layer on top of this. So here I'm going to just very casually show you some potential ways of trading, these corrective sequences. So here we have some moving averages. Notice how the moving averages are completely useless during periods of sideways corrective action. All right, I wouldn't say completely useless, but that's not where they shine. We can see here the moving averages cross up and down several times. That's definitely something that you tend to see during prolonged sideways corrections. All right, so now we've got these black trend lines. I like to trade breakouts. So, once we break out of this upper trend line, that's when I'd be looking to position myself in the market. Now here we have another sideways correction. All right, same kind of deal. We have very clear boundaries to this range here, and I'd be looking to trade a significant breakout of that range, like this candle right here. Notice how as we broke out of this longer sideways corrective sequence, our moving averages crossed in a bullish manner, and they stayed crossed the entire time. And in fact, in these two smaller corrective patterns, we found support alongside those moving averages. Okay, just taking a closer look now at that longer corrective sequence, notice how the moving averages, if you're following the moving averages and you're trying to trade based off of moving average crossovers, you would just get chopped up so many times here. Now that doesn't mean that the moving averages, are useless all the time, but I think during a sideways period of consolidation, it is very dangerous to rely on those moving average crossovers, right? If anything, they should be, when you see this kind of whipsawing back and forth, it should be a warning to you, to stay out of the market until we see a more sustainable, I'd say, resumption of the larger underlying trend. Okay. Now we're going to take a look at the Australian dollar, Canadian dollar currency pair on a 4-hour chart. And again, we have that same sequence. You'll notice this pattern repeating itself over and over in all markets, not just currencies. We have an impulsive movement followed by a corrective setback, impulsive movement followed by a corrective setback, on and on and on we go. So it's these corrective sequences where I want to be looking for trading opportunities. By the time an impulse wave is already underway, it's typically too late to join that trend. It's also very difficult to set an appropriate stop that makes the potential reward on that trade worth the risk that you have to take. Okay, adding another wrinkle to this is very cool. In corrective sequences, I personally love to look for Fibonacci retracement levels. I like to look for technical indicators that, give me high probability areas of support or resistance in this case when we're in a downtrend. So here we've got 20 and 50 period moving averages and Fibonacci retracement levels. It just so happens that every corrective sequence, in this downtrend found resistance rather at or near the 50% retracement level. Now we also see that the moving averages did a great job of containing price. So that's where we can layer on other technical studies to help pinpoint those areas where a corrective sequence might find resistance or support. Don't treat these technical indicators, like just because we break through a moving average for a few hours doesn't mean that the moving average hasn't held. False breakouts are very common, especially during a corrective sequence. That's how traders get trapped. So just like with Fibonacci retracement levels, don't treat them like hard lines in the sand. If I look at this example here where we retraced to 98.91 in Aussie Canada, we poked a few pips above that level. That doesn't mean that the Fibonacci level is no longer valid as resistance. Okay. And now here, finally, we're going to be taking a look at how these corrective sequences can be traded. And I've added in yet another wrinkle here, which is looking at very simple technical support and resistance. So here we have, a chart pattern, which I would call a bear flag. As an Elliott wave market analyst, this has a different name. It's called the zigzag in Elliott wave terminology. I don't care what you call it. That's not important. What's important is that you can recognize this as a corrective sequence. So notice as we break down out of this flag and we trade lower in impulsive fashion, look where the next corrective sequence finds resistance. We know from the prior slide that it's near the 50% retracement level of this impulsive leg down, but we also trade right into the prior swing low, which is acting as resistance, which is also where this trend line comes in, which is also where this moving average comes in. How cool is that? We then trade impulsively lower. We form a sideways little pennant here. Note the trend lines that are converging towards one another. And then we have resistance that's formed here, right along, again, the 50% retracement level, but also these moving averages. And then we break lower in impulsive fashion once more and look at where we find resistance at this prior swing low and also these moving averages. Now, this is what I would call a very technically clean trend. All right, this is a trader's dream. Not every market is going to be this straightforward or this easy to trade, but when you do see something like this, take advantage of it. This is, I think it was Jesse Livermore that had this saying where he just waits for the most obvious opportunities in the market, and then he just has to walk over to the corner and pick his money up. And that's my philosophy to trading. This is a perfect example, of where the money is just lying in the corner, waiting for you to come in and pick it up. All right, so that covers really the characteristics of corrective price action. Over the next couple of weeks, I'm going to be teaching you how to identify and set rules to identifying impulsive price action. And we're going to do the same with various corrective patterns as well. So you can now start taking this theory, the theoretical knowledge, and start applying it in a practical fashion. First in backtesting, right? Simulator trading, then demo trading. And then if everything works out, in simulator and then on demo, you can start incorporating it into your live trading plans. Okay, so to recap, again, giving you some homework here. Practice identifying corrective price action. If you want to send me your homework, you're more than welcome to email it to me or to any of the other Maverick trading coaches. Also, I'd love for you guys to combine other technical studies to find potential support and resistance areas. So whether it's moving averages, Bollinger Bands, momentum studies like the Relative Strength Index, a number of different things will come together to give you a probable stopping point where a corrective sequence is going to end. And then finally, focus on incorporating trading strategies that suit your individual needs as a trader. So I like to trade breakouts. That suits my personality very well. But if you like to, take a more I won't say a riskier or conservative approach, but if you want to take a different approach because that suits your personality better, then by all means do that. The bottom line here is that you should be playing to your unique and individual strengths as a trader. So thanks everyone. I hope you enjoyed this class, and I'll see you next week for some more technical analysis. Good stuff. All right, good stuff. Not sure what the right phrasing there is, but you get my point. All right, everyone, take care. See you soon.